Welcome to Disciple Wealth Strategies. My name is Austin Garner. In this video, I want to discuss and review some of the popular Christian financial strategies that are out there today. These are strategies that I personally believed in and what I practice personally, and also what I taught others when I was a financial advisor. And the fact is that I believed that if everyone would implement these strategies, that it would almost guarantee their financial success. And then I was confronted with reality. I discovered the truth, that it wasn't true. And so what I discovered is that my faith in these strategies was misplaced because it wasn't faith in God, it wasn't faith in the Bible, not even in myself, but it was in financial systems that were designed to benefit those who created them more than myself and my clients. And so in this video, we're going to point out some of those flaws that exist in those strategies and also isolate the truth of what's really going on. My goal here is not intended to be financial advice. I also am not intending to criticize anybody who wants to teach or practice these financial strategies. I solely want to provide education and additional information that maybe it'll be helpful for you to make the best financial decision you can. And the reason is because, I really do believe that Jesus meant what he said in John chapter 8, verse 32, when he said, the truth will set you free. I really believe that. If we discover the truth in our lives, in any area of our lives, it will be a means to freedom for us, and especially the truth of God's word. And Nelson said it this way. He said, if you know what's going on, you'll know what to do. And so that's what we're going to do in this video. So let's dig in. This document is a summary of some of the popular Christian financial strategies out there. And I created this document as a summary to kind of pull all these different views together. A lot of them are very similar. So it's really just a condensation or a summary of those various strategies combined together. And I created this years ago when I was first getting started as a financial advisor. And I also used this to manage my finances personally and what I coached others through. So we're going to dig into each one of these steps individually and look at the thinking behind them, and then also the underlying flaws that I discovered later. Step number 1. All right, so this is all about developing discipline. I know the word discipline today is like a dirty word. Like, what'd you say to me? But the reality is success cannot happen without discipline. Think about your favorite athletes and celebrities and whoever else. They may have talent, but talent by itself is not enough. That talent must be nurtured and defined and deployed appropriately, and that's discipline. And so everyone needs, just like that, they need that discipline in their finances as well. Everyone needs to learn to save and learn to control spending, and that's what this step 1 is about. Save up $1,000 to begin that development, and also create a spending plan and stick to it. Learn how the money is flowing through you, and set limitations on certain areas. And if you personally don't believe that you cannot save or that you cannot control your spending, the reality is that there's no strategy on the planet that can help you, because these disciplines are fundamental. They are the means to all financial success. You're not going to get there without them. All right. So step number 2 is about lowering hurdles. And more, you're going to start saving more, and then you're going to lower your expenses, mainly through debt. So as you save more, you're going to need less consumer debt because you'll have the cash to cover. And then you can start eliminating or expediting the elimination of your personal debt. And then as your expenses decrease over time, what was being paid to lenders can now start flowing towards you. Then you can move on to step number 3. And step 3 is about minimizing risk. So as you fully fund your emergency fund, 3 to 6 months of your expenses, again, more savings means less need for debt, especially for emergencies. I mean, using debt in an emergency situation is catastrophic because you already can't cover the emergency. Now you're going to add interest on top of that with a rigid payment schedule. So not a great idea. So having an emergency fund is a good idea. And then managing risk through life insurance, ID protection, and estate planning documents. The idea here is that while you're building wealth, while you're saving and developing that discipline, you utilize temporary insurance and estate planning documents to minimize your hindrances on your wealth building. And then also the transition of that wealth to other people if something were to happen to you. And then step number 4 is where you can start planning beyond your immediate needs and start investing in your future. Start planning for your future. You know, what are the major purchases you're going to need in the future? Are you going to have to buy a car? You're going to have a medical expense? You're going to buy a house, start a business, go on vacation, whatever it is. What are those major purchases that you're going to acquire? You're going to do. And also start thinking about your future income needs. How are you going to retire? You know, are you going to want to retire? Do you want the ability to retire? Start planning for that as well. And then step number 5 is where you transition to planning beyond yourself. You start investing in your kids, your grandkids, whoever, people you care about that you want to invest in their personal development. So utilizing like a 529 college savings plan is the strategy here. And then step number 6 is build wealth, have fun, and live generously. Man, this sounds so good. What could possibly be wrong with this process? Overall, the goal is good because just like we started at the very beginning, it begins the process of developing discipline to save more and control expenses, which minimizes debt. The problem lies in the specific strategies because they require false assumptions and they also ignore God's specific instructions to us. So let's first think about why it's good to develop discipline. We kind of already talked about this a little bit, but to go a little bit further, no matter what, you as an individual are going to suffer from one of 2 pains, either the pain of discipline or the pain of regret, which are the mistakes and the opportunities you're going to miss. And in my opinion, it's better to have discipline, suffer from the pain of discipline because you're in control of it, right? And so as you develop discipline in your life and you apply it to your finances, now you can start saving. Well, why is it good to save? Because life is expensive, right? You're going to need a lot of money. And if you don't save yourself, you will forever be dependent upon debt to others. But then why is it good to minimize debt? Well, I mean, just think about it. Lenders live very well off of just simply lending you money for the things that you're going to buy in your life. And by minimizing debt, you get to keep that money that would be the lender's profit. So developing discipline, saving, minimizing debt, those things are good. But do the typical strategies actually help us accomplish these goals effectively? The strategies mentioned in this process, in most of these popular Christian financial processes, are bank accounts, retirement plans, 529 plans, and temporary insurance products. So now let's dig deeper into each of these and look at what's going on. Bank accounts. It's a sinking fund. The idea is that you save up over time and then you spend it down. You save up over time and you spend it down. So if you're going to pay cash for your needs, you got to store that money somewhere. And how much money are you going to need? It's going to take time to build it up. Well, how much money are you going to need over your lifetime to if you're going to pay cash, if you're going to utilize this strategy, how much money are you going to need access to? I mean, think about the cars alone that you have driven so far in your life and the cars you're going to continue to drive in your life. How much money is it going to cost to purchase and utilize those vehicles? It's going to be expensive. You add a spouse, maybe your kids when they become driving age. I mean, we're easily talking about millions of dollars just in vehicles over lifetime, over life, throughout life. And then you throw houses and education and recreation, vacation, all, medical, all that stuff. You start really adding up the numbers of how much money you're going to need access to over your lifetime. It becomes staggering. So imagine for a moment that you have access to a large pool of money that's going to help you finance these things. Ideally, where would you want to store it? Well, I mean, first of all, you would want it safe from theft, inflation, and risk, right? You know you're going to need it. Why would you want to risk it? You need those things. You want minimal risk. And you also don't want anybody to steal it. But then, because of the problem of inflation, we also want to protect it from inflation. But then when we do have a need, we want to be able to access those funds when we need it. And ideally, we would want that account to grow as much as possible, even though it's minimal risk. And then it'd be great if it was all on a tax-free basis. Okay. Do bank accounts actually provide this ideal product? No, not really. I mean, inflation itself, if you look at the formula, I think a good source, Shadow Stats is a good resource. Check it out. Go to their website. And what they do is they track the inflation based on a formula from the 80s and 90s. They have a couple different scenarios. And what they're doing is revealing that the formulas keep getting changed over time to make it seem like inflation is less than it really is. So if you look at what inflation really is, I mean, you and I are experiencing it, especially now in 2024 and 2023. Inflation is the highest it's been in decades. But if you look at the actual average with the original formula used in the 80s and 90s, inflation's more like 5 to 10% over the last 40 years. Not the mystical 2% that we keep hearing about. Okay, so, bank accounts for the most part are protected from theft, though. I mean, unless there's a bank robbery, but even then there's insurance in place to help make account holders whole, that we still have access to our money. And also they're not market correlated, so there's hardly any risk. But it's mainly the inflation that's the problem. Our money stored in bank accounts are not inflation protected. But then what about access? I mean, for the most part, yeah, you go to a bank, you get your money out, 100%, until it's not accessible. And what I mean is, like, we're already hearing stories in the media about banks freezing accounts or closing accounts for various reasons. And also after the 2008-2009 financial crisis, legislation was actually passed that limited banks' abilities to receive government bailouts again if there were a future financial crisis. Instead, what they did was allowed for bail-ins, which basically gives banks the legal authority to confiscate depositor funds in order to maintain solvency. Obviously, it hasn't been tested yet, but the legislation was passed, and we're just waiting for another financial crisis for that scenario to play out. We don't know how catastrophic it could be, but regardless, it's there. Check it out for yourself. Look for the bank bail-in situation. But then what about growth? I mean, we just talked about it. Typically, bank accounts, the interest rate on bank accounts is significantly lower than the inflation rate throughout history. Even I had clients that they would brag about back in the early 80s when they would get 12% in a bank account. But then when I asked, well, what was the inflation rate? They would say, oh, never. They would just kind of hum and ignore it. The inflation is almost always higher than the interest rates. Almost always. Maybe always. So anyway, these accounts are just losing slowly over time. But then when you access the funds and make withdrawals to purchase the things that you need in your life, you're going to interrupt the compounding effect. And so you have lost the future opportunity to earn interest on that money forever. You're never going to get it back. What about taxes? Well, if you do get any interest, it's going to be taxed. You pay taxes on the money you put in through income taxes, but then any interest you gain in the year, you have to pay taxes on. Okay. So, yes, bank accounts are not ideal for what we need. But let's think about from the other side. What does the bank think about us storing a significant portion of our savings with them? Well, they love it, right? They want you to store all of your money with them. Why? Because they practice fractional reserve lending. And there are a lot of misconceptions on what fractional reserve lending is. There's an idea floating around that if there is a 10% reserve requirement for banks, that means that of all their pool of capital, their deposits, they have to keep 10% on reserve, and they can lend out the 90%. So that would mean that their loans, their total outstanding loans, could not be more than 90% of their total deposits. Right? Is that true? No. Logic tells you that their outstanding loans far exceed their total deposits. Far exceed. How is that possible? Because what's really happening is the deposits left with the bank, are actually the 10% capital reserves that the bank's utilizing to leverage. And they're leveraging to lend out the 90%. For example, let me explain this. If I go to a bank and deposit $1,000 in the bank, yes, my balance goes up by $1,000, but so does the capital of the bank. And so my balance went up $1,000, their capital went up $1,000, their reserve capital. They can lend $9,000 on top of my $1,000. They have the authority to lend $9,000 on top of my $1,000. That's what fractional reserve lending is. But where do they get that money? It never existed before. It's never existed. This is what is meant by the term printing money. And when more money is being created and is being used to purchase things in the economy and circulates in the economy, that's called monetary inflation. And what's going to happen to prices? They're going to go up too, price inflation. And the worst part is if you go get a loan at a bank, they're going to issue money to you if you qualify. They're going to lend you money, again, that's never existed before. What are you going to pay it back with, that loan back with? You're going to go out in the world and earn money, real money, and pay it back. You're going to give the bank your real money that you worked hard for as payment for them lending you money that's never existed before. This is what Nelson Nash meant when he said, banks lend money that doesn't exist, and that is evil. It's evil. And by saving large sums of money in bank accounts, maybe you're not using debt per se, but your deposits are feeding the debt machine. That is allowing them to massively inflate the money supply and silently steal our wealth. A lot of people like to blame the Federal Reserve with the help from the government for causing inflation, which they do, but the banks that you and I do business with, the commercial, the local banks, they create a majority of the inflation in our economy because they hold most of the nation's loans. Now, I do want to clarify that, yes, I still use bank accounts, but my purpose for using them is for transactions only. They have created a very convenient system for transacting business. So I keep just enough money there to manage transactions. I do not store a bulk of my savings there because of these serious flaws that exist in the banking system. And these are flaws that you should consider as well in your financial planning. But what about retirement plans? I mean, retirement plans are a sinking fund too. They're just over a longer period of time. You're going to save up over decades, and then you're going to spend down over decades. And so, I mean, if you want a decent income in retirement, how much money are you going to need, and for how long are you going to need it to generate that income? Again, millions of dollars. And so, if you have this millions of dollars, where would you like to store it for your retirement needs? I mean, well, ideally, I want it in a place that can generate substantial income on a guaranteed basis, as guaranteed as possible, and as high as possible. And ideally, I would love it to grow as much as possible. And I would love it to be all on a tax-free basis. I would love to have control over how much I can put in, when I can put it in, how much I can take out, when I can take it out. Maybe control over the investment portfolio, how the funds are deployed. I would like to have that control, that option anyway. And I would like all this as low risk as possible. I know that's ideal. It sounds ridiculous, but play along with me here. These are what people want. This is the ideal characteristics. If you were to design your own product for your retirement needs, but do retirement accounts provide any of this? Not really. I mean, some might argue a few points of it might be somewhat met, but let's think about the income. So there's this financial rule called the 4% income rule that's out there, and it says that if you want your account to last your whole life and not worry about running out of money before you die, then you must limit your withdrawals to around 4% or less per year. And obviously it's a market correlated account, so it's definitely not guaranteed. Now you could use like an annuity type product, like an insurance product that can have some guarantees, but that's an exception, at least on the guaranteed part. But just imagine like 4% is a small number. That means that the 96% has to be a big number in order for you to generate that 4% if you want a decent amount of income. But then what about growth? This depends on your perspective too. Like, is 8, 10, 12% a good rate of return for you? I mean, is that the best you can do? What's staggering to me is that it seems like we've been conditioned to believe that this is the best we can do. And there's also a major misconception on what the average annual interest rate is, or return is. Just because you have a positive average annual return does not mean your account balance is growing. And there's a lot of information on that, like different scenarios you can run to play around with that. But the average annual rate that is reported on these portfolios is a deceitful number. You should look more into it on how much money you're actually receiving in your account each year. What about taxes? Well, there's a few different ways to do this, but like majority of people have a traditional style retirement plan, like 401k, IRA. And those taxes, you put money in and you get a tax deduction in the year you make a contribution. But then later, when you withdraw, you have to pay the taxes at that time. You have to pay the taxes in the future, sometimes decades in the future, when you have no idea how much money you're going to need for income and what the tax brackets are going to be. And then on top of that, if your employer matches, Now you're compounding those taxes even further into the future because your employer, for the most part, is just transitioning their tax burden over to you. And so it's creating a bigger tax scenario in the future that you have no idea. You don't have no idea what it's going to be. And then what about control? Very little control in these plans. You have a small selection of investment plans, but they're very limited, and they all pretty much, I mean, a lot of them are the same. There's stocks and bonds and a few other various assets, but you're limited on how much you can put in, when you can put it in, when you can take the money out, how much you can take out, and the portfolio. Very little control. Our control is abdicated to governments who sponsor them and to Wall Street who manages them. And then the risk aspect. Well, the reality is, like, even in a conservative bond portfolio, I mean, reality is you can lose it all in retirement, theoretically, or a big chunk of it that can severely hurt you, which a lot of my clients did. When they went through the 2008 crisis. So in reality, participants in the typical retirement plans, they have 0% control, yet they take 100% of the risk. Let that sink in. But then how do the plan managers, the other side, the proponents of these plans, the managers of these plans, what do they think about you storing your money with them? Well, again, they love it. Because the brokers, the administrators, the securities exchanges, all the other the middlemen, they're collecting fees and commissions up front. And the more you leave with them, the more those fees and commissions go up, typically. So they have 100% control with 0% risk. $529 plans are pretty much the same as retirement plans. Ideally, if I'm going to invest in the personal development of someone I care about, I want as much growth as I can get. I want to use those funds flexibly because I don't know what they're ultimately going to do. So I want to be able to use the funds however is needed for me to invest in that person. And I want the same controls as I have if I'm as like the retirement plan. I want to be able to put as much in as I want, whenever I want, take money out whenever I want, as much as I want. And I would love control over the deployment of those funds if I want. I would love no risk or minimal risk, and I would love it to be on a tax-free basis. But the problem is school costs are almost guaranteed to increase every single year, so much so that the investments can't even keep up. There's no way they can keep up. But why do school costs go up so dramatically every single year? I mean, think about it. How is school cost typically paid for? Student loan debt and government subsidies. And those government subsidies, well, they're not raising taxes to pay for it. So most of the time, they're just getting more debt to pay for it. The national debt goes up. So just as we talked about, banks lend money that doesn't exist. So those loans, student loans and government loans to pay for school costs, those loans are causing inflation. And when those inflationary dollars are purchasing educational credits, that means prices are going to skyrocket unnecessarily. There's going to be excessive demand. There's going to be excessive price increase because of the dollars that are being created to finance them. So in comparison to the scenario of a family who utilized 529 plans, I want to share a story from a client that practices the infinite banking concept. What they did to manage their college expenses rather than 529 plans. So husband and wife, I think they have 4 sons, and when they're older, years ago, they started infinite banking style whole life insurance contracts for their kids. And when the oldest one graduated high school and was ready to move off to college, the parents showed him, they walked him through the process of taking a policy loan from his policy, taking that money and purchasing a house in the town where he was going to go to college. Then he found roommates and made them pay rent, which was a very decent income for a poor college student to pay for his school. And over that 4 years, what do you suppose happened to the value of the home? It went up. So when he graduated, not only did he collect all the rent payments, he also had a profit on the value of the home. Well, about that time, when he was ready to graduate, his younger brother, the second oldest, was graduating high school and moving off to college, wanted to go to the same school as his brother. So older brother sold it at current market prices to younger brother. How did he pay for it? Well, his parents walked him through the process of taking a policy loan, paying cash for the house, and then renting it out to other roommates and continuing that process over and over. So in this scenario, what do you think the financial return was? A lot more than the 529 plan, and a lot more fun, and a lot more educational. Imagine the education that these kids received in finance, in entrepreneurship, in business, in customer service, if they're a landlord, basically. I mean, they are getting a better education in this process than they would ever get in a classroom. That's hands down a better scenario. Well, let's go a little bit deeper into retirement 529 plans. So the typical investments in these are mutual funds. And inside of mutual funds are stocks and bonds and various other assets, but primarily stocks and bonds. But what is a stock? There's so much excitement around stocks. What is a stock? Well, it's a partial ownership in the equity position of an underlying company. So if you are a partial owner of the equity of a particular company and you want the value of that stock to go up, how's it going to go up? Well, the company could do really good business. Is that going to make the stock go up? No. But good performance of a company may incentivize or may encourage people that it is a good company worthy to be invested in, which could give them the correct perception to want to buy that stock. And so when they buy the stock, if more people are willing to buy that stock, then the price goes up. If more people want to sell the stock, it will go down. It really doesn't matter what the company does. A company can perform very well, but the stock can go down. They can perform poorly and the stock can go up. It's all about the perception of people are more willing to buy it than sell it. And then when you purchase those shares, where are you going to go? You're going to go to the stock exchange. When you pay your money and acquire that share of stock, where's your money going to go? Not to the company. It goes to the seller. But then what about bonds? I mean, as we've experienced in the last year, bonds can be just as volatile as stocks. And think about it, bond is a debt instrument. So when a company issues bonds, that means they're going into debt to you and I. If we buy those bonds, then we are lenders to that company. Well, I mean, just like any debt, it's a cost to the company. And who's going to pay for that cost? Who's going to pay that cost? Well, the company's going to pass it on to their consumers. And the same with government debt. when a government issues bonds, how are they going to pay for it? Well, they're going to have to increase taxes or use future debt to pay off the old debt. I mean, either way, it's going to increase costs. It's going to hurt the end person, the taxpayer or the consumer. But let's think about this for a second. I mean, think about all the exchanges in the world, the bond exchanges, the stock exchanges, all those exchanges all over the world. Who started them? Who owns them today? Who controls them? It's the big banks. It's the big global banks. I actually had someone tell me this one time. They said, "Oh, I don't trust banks, so I save my money in brokerage accounts." It's the same people. It's the same people. The people who own and control the banks own and control the brokerage accounts. I want to read a quote from Dave Ramsey's book, Total Money Makeover. In chapter 1, he's kind of laying out his story of how, his financial crisis and then what kind of became the foundation for his change. He said, "It seemed every month I sat at the same table with the same worries, fears, and problems. I had too much debt, too little savings, and no sense of control over my life. No matter how hard I worked, it seemed I couldn't win. I was to forever be slave to some banker, to the government, and to the needs of my family. All the money came in, and all the money went out." So Dave's fear was that he would forever be slave to bankers, governments, and to the perceived needs of his family. And he goes on to say that by changing his behavior, by developing discipline in savings and controlling his spending, he was able to gain better control over his life. That's good. But his advice, along with other popular financial educators, their advice directly supports and creates dependency on the very institutions that Dave claims he was enslaved to. And because of this, banks, Wall Street, and governments will continue to profit from our behavior more than we do. Ecclesiastes chapter 11, verse 2 is the one single Bible verse that is used over and over again to teach people. It becomes the basis for people to invest in mutual funds and investment portfolios. Let me read it. It says, "Invest in 7 ventures, yes, in 8. You do not know what disaster may come upon the land." This verse is obviously talking about diversification of your investments. But is it talking about mutual funds, though? Well, what did Solomon mean by venture? I mean, if you just look that word up, it means a speculative business enterprise. I mean, it could be anything. But at this time, stocks and mutual funds didn't exist. Investors had to be intimately involved in the enterprise. They had to know what's going on. It was preferably a business they were well educated in. They knew how to make profit. And it was a business that they wanted to invest in to help the business make a bigger impact and be more profitable. I've actually found that many Christians believe they are obeying this verse when they buy stocks and mutual funds. But again, when you buy a stock, where does your money go? Not to the company, to the sellers. The company received their capital when they issued the shares. It's called an IPO, initial public offering. They can also issue new shares after that, to raise more capital. But the day-to-day trading of their shares does not generate additional capital for the company. I mean, it benefits the company in some ways, but more on that at a different time. But when I buy a share of stock, it does not go to the company. It goes to the seller, plus fees for the middleman. If more people buy it, the stock goes up. If more people sell it, the stock goes down, regardless of how well the company performs. But there is a biblical example, though, that for the most part seems to match up to the philosophy of participating in retirement plans and investment portfolios. And that is Luke chapter 12, verses 16 through 21. Jesus said this parable. He said, "The ground of a certain rich man yielded an abundant harvest. He thought to himself, 'What shall I do? I have no place to store my crops.' Then he said, 'This is what I'll do. I'll tear down my barns and build bigger ones, and there I will store up my surplus grain. And I'll say to myself, you have plenty of grain laid up for many years. Take life easy, eat, drink, and be merry.' But God said to him, 'You fool, this very night your life will be demanded from you. Then who will get what you have prepared for yourself? This is how it will be with whoever stores up things for themselves, but is not rich towards God.'" So I want to point out that Jesus did not indicate whatsoever that he had a problem with the farmer saving or being successful at all. His concern was that as God blessed the farmer hoarded God's blessings excessively for himself rather than deploy those resources for God's purpose. Now, if the farmer's motivation was to build bigger barns so that he could expand his farm operation and therefore provide more food and jobs for the community, I think Jesus' response would be much different. The whole idea of retirement plans and market-based investments is to accumulate more money for ourselves without limitation, just like this farmer in the parable. I mean, the reality is that most people are not involved in the deployment of their money, and they don't want to be involved. They just close their eyes and wish for the best. Now, again, I'm not saying that you shouldn't use these types of strategies. That's for you to decide. But what I am saying is that we should stop calling these plans biblical financial strategies. They're not. Now let's cover the temporary insurance part of this financial process. So at the very top, manage risk. There's a good question here. It says, how would you pay bills if something happened to you? That is a good question. I mean, you should ask yourself that question and have a plan to answer it. I mean, you should protect yourself. You should protect your family from unnecessary risk. But are the suggested strategies the proper way to do it? Maybe. Let's start with term life. So it says here, by the time you retire, you should have enough wealth built to insure yourself. All right, so you use temporary insurance, 10, 20, 30 year, whatever it is, for a period of time while you're saving. And the plan is that you're going to have enough savings where you can self-insure. Where are you going to store your savings? Well, we just went through the process. Bank accounts and retirement plans. So in essence, what this means is that you are gambling. I mean, you are betting your future that you will have enough in retirement plans and bank accounts to not need any form of life insurance. And we just talked about some of the flaws that are existing here. But let's play it out. Let's play it out. So if you have a substantial amount of money saved up in retirement plans, that is going to be somewhat of a life insurance replacement. You're not going to need life insurance. Let's play it out. All right, so, maybe you pass away after your life insurance expires. And let's start with your spouse. If your spouse is still alive, she's the beneficiary, or he, either one, if they receive that account after you're gone, how is it going to transfer to them? Well, if it's a spouse, there's a choice to make. The spouse can receive a retirement account as their own, and it would be managed just like if it was their own from the very beginning, or they can receive it as an inherited account. Very different rules associated with inherited retirement accounts. If they receive it as their own, if they're younger than 59 and a half, they're going to have penalties. They will have early withdrawal penalties. So if they do not have substantial income or enough income to sustain themselves, and they are forced to take withdrawals in order to get them through the transition process without you, they're going to get taxes and penalties on those funds, which is going to hinder their blessing, the blessing of those funds. But if conversely, they can receive that account as an inherited account, which gives them the ability to withdraw it without penalty, but they have to completely empty the account in 10 years. So not a long-term solution there for family wealth and future income. And then if it's a non-spouse, say it's your kid, say maybe you live, 80, 85, and your spouse is already gone, and so now your wealth stored up in retirement plans is going to transition to your children. Well, how old are your children? If you're 80, 85, your kids are probably 50s, 60s. How much income are they earning? The most they've ever earned. They're in their peak earning years. And because they are a non-spouse, they can only receive those retirement accounts, as inherited, which means the accounts have to be empty in 10 years or less. So they are going to have to take withdrawals in their peak earning years, which could potentially put them in a higher tax bracket than they already are. Either way, whether it's spouse, non-spouse, owner received or inherited, doesn't matter. Retirement accounts transitioned to other family members do not preserve family wealth. Matter of fact, I believe they hinder it. They hinder the preservation of family wealth. With this way of thinking, you are gambling with your future needs, on something that you have 0% control over. This, to me, does not sound like a risk reduction, but a risk increase. Or maybe I just don't have enough faith. In part 4 of my Becoming a Biblical Lender video series, I point out that Jesus reveals 3 choices that each of his servants can make with the blessings he left them, with the finances, the money that he left them. He said, you can do nothing, you can give it to the bankers to manage on your behalf, or you can be the banker yourself, deploy those funds yourself. Now, in the parable, Jesus seems to prefer that his servants choose option 3, to do what the bankers would do, to lend it out, to deploy it into the community for profit, for impact. But he gives room for us to choose option 2. But remember, in the parable, option 2 is an exception to his command. He prefers us to be the banker, to deploy the funds ourselves, to do what the bankers would do. But he gave an exception to his command to account for disobedience. The typical Christian financial strategies teach us how to do option 2 only. And they do teach that it can be profitable. I mean, it's better than doing nothing. It definitely improves things, right? And there's nothing wrong with somebody wanting to do this. I just wish that the proponents of it would stop calling it God's way. Conversely, what I teach, which is based on what Nelson Nash taught, is the absolute simplest and best way that we as servants of Christ can do option 2 and option 3 if we want to. You know, the infinite banking concept is about utilizing whole life insurance to control the banking function in our lives. So I can let the insurance company deploy my money on my behalf. They can be my banker. I can let them be my banker. But I also have a contractually guaranteed right to access to that money to deploy it myself for however I see fit. That's option 3. And it's exactly like starting a privatized banking system where I'm the owner and I can also be the banker who deploys the capital myself for my needs, for other people's needs, whatever. And just by simply taking over the lending function in your life, in your family's life, the actual results of option 3 can greatly exceed the potential results of option 2, just as Jesus taught in the parable. It is a fundamental principle that God himself established for us to discover, for us to implement in our life, and to be a blessing in the world around us. So, because of this, my opinion, which, I mean, it's based on my own observation and my own experience, popular Christian financial strategies today are wholly inadequate for disciples of Christ to best steward, to best manage their financial resources according to God's specific instructions. The fact is, properly structured, high cash value, dividend paying, mutually owned whole life insurance actually has all the right characteristics to be the ideal financial product to help us meet all the financial needs that we discussed in this video. It provides safety from theft. I mean, when's the last time you heard of an insurance company getting robbed or hacked? Whatever. A lot of people are aware that also life insurance is a great hedge against inflation. And they're not stock market correlated, so there's very little risk. They actually have guarantees, so there's almost no risk, but I can't say that. But then, because it's high cash value, I'm specifically structuring it to grow cash value pretty quickly. I have access to a substantial portion of cash anytime I want. I just have to request it. And just like I described, all the control and the flexibility of use is in my hands. I can put as much in as I want, whenever I want. I can take as much out as I want, whenever I want, as long as it's within the parameters of the design of the specific contract. There's minimums and maximums, but within those parameters, the freedom is in your hands. And because you can access the funds through policy loans that do not actually withdraw the funds out of the policy, you can actually continue compounding uninterrupted, but still have access to the money in a contractually favorable way. And for the income, life insurance, structured this way, can produce substantial tax-free passive income later in life. And it's not restricted to a certain age. It's whenever you want. And to give an example, the first policy that I purchased when I first discovered this, I just did a quick calculation on a conservative amount that I could generate from this one policy. That one policy, I will be able to withdraw about 7.6% of the cash value, the total cash value. I think at age 65 is when I did it. That's That's almost double the 4% income rule. So if I can withdraw more on a consistent basis every single year, that's on a more of a guaranteed basis, not stock market correlated. Remember, it has consistent compounding growth, some of it on a guaranteed basis. Well, now I have more guaranteed access to that income, that 7%, 7.6% that I can withdraw or access. Which means if I want the same income, I can have a smaller number, a smaller total balance, because I have access to more per year. But then the reality is that even if I withdraw this portion consistently, the policy still continues growing. And so I have the potential to increase my income every single year after that, to make sure that I'm keeping up with the cost of living increases. But then, I mean, if when I pass away, even if I have used it for substantial income or my financing the things of my life, it's still, because of the death benefit, life insurance is the absolute most efficient wealth transfer product. It's all private and it's all on a tax-free basis. And all of this, everything that I'm doing, when I put money in, when I take money out, when I use policy loans, when I leave a death benefit, when I take income, all of this is all done. All this can be done on a tax-free basis. The problem, why this isn't a normal thing for everybody to do, is because it was called life insurance. And when most people hear the words life insurance, they close their minds to this idea, and they never investigate for themselves the transformative power and flexibility that this very old financial product provides. What a shame. Well, that's it for this video. I hope you enjoyed it. I hope it was helpful in revealing some of what's going on in the financial world today. But most of all, I hope this helps you be better equipped in making good financial decisions for you and your family. So until next time, I thank you for watching. Have a great day.